kids that when they're old enough, they'll tell me that they're excited to do the same.
What's important is to find a good reason to invest. It becomes so much easier when you visualize your goal.
People think I travel so much, and I have a YOLO or you only live once attitude. But the truth is, I travel because that's my business, and I make sure I invest in it, spend time for it, to give people the best experiences they deserve.
When people find out that they invest for what I'm passionate about, they always say, "What?" But I always just tell them that I can afford to fund my passions because of my investments.
The thing is, some people are just too shy to ask for financial advice. Like asking for help is seen as a sign of weakness, when in fact, it's through asking that we learn the best way of doing things, even in investing. With ATRAM, you can engage and be confident that you have a partner in achieving your financial goals.
People usually think investing means buying a house or retiring. Sure, it can, but saving for smaller goals is another way to do it.
People think investing is expensive. Nowadays, even with a small amount of money, you can already begin your investment with ATRAM. It's easy to make it a monthly or even a weekly routine. ATRAM makes investing simple, even for busy moms like me.
And even if you're always on the go, like me, you can keep an eye on your investments online. Plus, I'm confident that ATRAM, my trusted partner, will take care of my portfolio and make sure it gets invested in the right place.
Never settle for average. Why? Because life is what we make it. And a strong investment partner can help us live the life we want.
ATRAM is dedicated to delivering an investment experience that helps people get more out of life. In fact, it was built with that single focus, to help clients attain their investment objectives. We see Filipinos invest in their dreams and aspirations. With ATRAM, building the future is a task we can surely take on.
With ATRAM,
You
Can take on tomorrow.
Rampver envisions itself to be the leading financial intermediary, advisory, training, and consulting team that provides access to the best organizations, products and services, offering strategies and unbiased solutions for wealth management with exceptional services that exceed clients' expectations. Rampver Financial's humble mission is to help people fulfill financial dreams. It offers a unique and complete platform of financial services which comprehensively matches any individual or institution's financial goals through mutual funds, life and non-life insurance, healthcare, and other financial services, complemented by an effective financial literacy platform and supported by reputable local and global partners. Rampver Financials has placed itself at the forefront of the Philippine financial services industry. Rampver Financials commits to continue learning as much as we guide, to listen as much as we coach, to work as much as we dream. It is time to make Rampver Financials your partner in wealth creation. Rampver Financials, helping people fulfill financial dreams.
We Filipinos still have a long way to go when it comes to investing for the future. We seem to prioritize instant gratification, but I think how to invest properly is something that we all need to be familiar with.
it's simple, really. You work today, you invest, then live better tomorrow.
Besides, investing shouldn't be scary, It doesn't have to be overwhelming. I mean, I started when I was a teen. I hope that I inspire my kids that when they're old enough, they'll tell me that they're excited to do the same.
What's important is to find a good reason to invest. It becomes so much easier when you visualize your goal.
People think I travel so much, and I have a YOLO or you only live once attitude. But the truth is, I travel because that's my business, and I make sure I invest in it, spend time for it, to give people the best experiences they deserve.
When people find out that they invest for what I'm passionate about, they always say, "What?" But I always just tell them that I can afford to fund my passions because of my investments.
The thing is, some people are just too shy to ask for financial advice. Like asking for help is seen as a sign of weakness, when in fact, it's through asking that we learn the best way of doing things, even in investing. With ATRAM, you can engage and be confident that you have a partner in achieving your financial goals.
People usually think investing means buying a house or retiring. Sure, it can. But saving for smaller goals is another way to do it.
People think investing is expensive. Nowadays, even with a small amount of money, you can already begin your investment with ATRAM. It's easy to make it a monthly or even a weekly routine. ATRAM makes investing simple, even for busy moms like me.
And even if you're always on the go, like me, you can keep an eye on your investments online. Plus, I'm confident that ATRAM, my trusted partner, will take care of my portfolio and make sure it gets invested in the right place.
Never settle for average. Why? Because life is what we make it. And a strong investment partner can help us live the life we want.
ATRAM is dedicated to delivering an investment experience that helps people get more out of life. In fact, it was built with that single focus: to help clients attain their investment objectives. We see Filipinos invest in their dreams and aspirations. With ATRAM, building the future is a task we can surely take on.
With ATRAM,
You
Can take on tomorrow.
tomorrow.
Good afternoon. May I invite everyone to kindly pause for a while as we start this event with a short prayer. Let us put ourselves in the presence of God. Almighty and ever-loving God, we praise you, we glorify you, and give thanks for all your blessings. We pray for the success of this webinar. Please bless the speakers, our partners, and guests. May it be another channel for us to learn new things and help make a difference in the lives of other people. May we continue to be living witnesses of your love, protection, and guidance. Always keep us and our loved ones safe and healthy. All this we ask in the name of Jesus Christ, our Lord and Savior. Amen. Okay. Good afternoon, everyone. Welcome to today's exclusive webinar entitled The Election, the Stock Market, and Your Portfolio, brought to you by Rampver Financials in partnership with Soldivo Funds and ATR Asset Management Inc. or ATRAM. This is Kim Sayo from Rampver Financials, and I will be your host for today. Kamusta po kayo mga ka-RFF? I hope everyone's doing well despite the market volatilities and feelings of uncertainties for the past few days. I'm sure there's some mix of emotions sa naging resulta ng nakaraang elections dahil iba-iba din po tayo no, ng mga gustong kandidato. Perhaps it is also during these times when we wonder and ask a lot about the impact of these current events in our own investment portfolios. Marami pong nagtatanong sa amin kung okay pa ba to hold on to their investments or magdagdag or better na mag-redeem na muna and have a wait and see attitude. That is also one of the main reasons why we organize this exclusive event in cooperation with one of our mutual fund partners, ATRAM. So we could share with you our views and thoughts about investing during volatile markets and in times of uncertainties. So we have invited two financial experts who will discuss what is really happening in our local and global markets, as well as share with us what we could expect given different factors. There will also be a Q&A session to follow immediately after their presentations. So please feel free to drop in your questions in the Q&A box found below your screen, and we will try to answer them live later on. And to make things more exciting, ATRAM will be giving away 1,000 pesos each worth of investments through Seedbox. So please stay tuned and you may be one of our lucky winners. And before we introduce our first speaker, may we first invite you to subscribe to our YouTube and TikTok channels where you could find valuable contents that will help you in your financial journey. And thank you so much for the support, and we hope to see you join us in our growing RFF community soon. So moving on, for today's webinar, allow me to quickly run through a few house rules. And first is, recording of this webinar is strictly prohibited. And to avoid distractions, we will be muting your audio during the webinar. And lastly, maximize the Zoom group chat and Q&A button if you have any comments or questions. And so now, let's sit back, relax, and we will now formally start our program. So to introduce our first guest speaker, he is the lead independent director of two listed companies, Globe Telecom and Ayala Land Logistics Holdings Corporation, and an independent director of two other listed firms, Ayala Land and the National Reinsurance Corporation of the Philippines. He is also chairman of Singapore Life, a director of Esquire Financing, the Cullinan Group, Technomarine Philippines, Seven Tall Trees Events Company, and Mobile Group Inc. He is a member of Brother Bo Sanchez's Mastermind Group and is cited by many as one of the best leadership, business strategy, investments, marketing, and sales speakers in the country today. He's the author of two books, Trailblazing Success and Firing on All Cylinders, which are both certified national bestsellers. And finally, he's the president and CEO of Rampver Financials. Friends, join me in welcoming the Mr. Rex Mendoza. Hi, boss.
Thank
Good
you, Kim. Thank you for such a generous introduction. Good afternoon, everyone. It is really an honor and a privilege for all of us to have you. I think this is going to be such an interesting afternoon. Many of you are thinking, what will Rampver be presenting? If you remember, right after the elections, I came up with a market letter. We want to be ahead. You have given us the responsibility to guide you in your financial journey. It is incumbent upon us to take that lead. Whether a lot of people feel it might be controversial, many people probably will not be able to take a strong stand or a probable read of the market. We'd like to be able to do that. And for this reason, I think I know a lot of you are really going to be interested in seeing what do we have to present for today. But let me just first get on my slides on screen. Hope you can give me a few seconds to do this. Okay, I hope everyone's seeing the slides that I prepared for this afternoon. And we entitled this event, The Election, the Stock Market, and your portfolio. Certainly, a position of uncertainty for everyone. I don't exactly care if you have rooted for a particular candidate or another. See, the challenge for Rampver today is to make this an apolitical discussion. And that's going to be quite a challenge because we've just gone through a political exercise. And how can one be apolitical in a political exercise? The key thing here for us today is to make sure we're going to be nonpartisan. That's the difference. You can actually deal with a controversial topic like an election and its impact to the market if you get yourself into a perspective that is nonpartisan. And what do I mean by that? We are going to be trying to be as objective as possible. Yes, I think that's the vogue right now, and I hear it everywhere. It's called real talk. That's what they say about it. When it's real talk, it's more facts rather than emotions and opinions. But I cannot help but say, part of the things I'm going to be saying will be opinionated. But I will say when it is my opinion and when is it factual. I think that's very important. The other thing that I'd really want to share with all of you guys is the fact that most of the information that we're going to be talking about this afternoon were drawn not just from our own research, but from the research of the best of the best. And I'll give them, due credit for this. My good friend Edward Lee of Call Financials have graciously lent me some of his slides. The read of one of our big and best fund managers, ATR Asset Management, is also backing us up. But, we didn't stop with a local front. We're Rampver Financials. We will have to drill down and check out what the international market is saying about this market as well. And we've linked up with EFG Bank. It's a Swiss bank. And we're also getting inputs from Morgan Stanley. But it doesn't stop there. There are a lot of other sources because we know if you're from Rampver Financials, you're part of our community, Rampver Financials friends, most of you won't do your own research. Most of you will rely on us to do it for you. And we take it as a privilege to be able to do that. And for that particular position, let us, synthesize all of these things. Again, focusing on this election, it is over. We have chosen new leaders. Whether we agree with it or not, the most important thing here is this. A democratic government will have to have two strong legs, an administration and an opposition. Real success will not be driven just by an administration. Real country success is also driven by what the opposition does. Is it going to be a vibrant and robust competition? Is it going to hold on to and drag down certain projects? It will be dependent on what we're going to do. I mean, there has to be check and balance, but it has to be constructive. That moving forward, my friends, is how democracy works. Whether we agree with the result or not, after the election, we all have roles and we all have our responsibilities in nation building. But let me check out whether, as I've said, we agree with the results or not. What were the results, basically? Well, the international market has practically defined our elections to be generally peaceful. There is a massive turnout. There were a lot of people who went out and voted, much, much more than they did in the past. But the winner has a majority mandate. A majority mandate, I guess, for the first time in our democratic history, since his father in 1969. We never had a majority president until now. And on top of this, that particular administration today is backed up by such a powerful coalition because both the Senate and the House are actually on their sense of power might not be there as we have seen it in the past. However, this can go both ways. An administration who has full support of the legislature can actually push forward with a lot of projects which can be good for the country. But it can also elect to do the wrong things. And that's a reason why we still have to be vigilant and we still have to be, real concerned as a people. But as I've said, we have to be very, very constructive with the way we push for things. The control of both houses can be a blessing and a curse. And it depends on how a leader would use that to his advantage or to the advantage of the nation as a whole. However, a lot of people would say this, oops, lack of confidence. Oops, that's not what business wants. That's not what the international community wants. And because of that, wow, PSEI dropped 270 points in about 5 trading days, erasing 4% of its value. I guess in situations like this, we always get to ask, why? It's a loss of confidence. But you see, we don't have to stop there. Why the loss of confidence? You don't just ask why, and the answer is loss of confidence. Quite frankly, if you're a market player, you understand this. Loss of confidence is always the reason for a market drop. It's always the cause for reason for a market drop. So you have to ask, why the loss of confidence? Is it because they don't like the results of the elections? Or there are other reasons for the loss of confidence? That is real talk. We will have to look at other reasons, maybe bigger reasons for this drop. One of the first and foremost of this list is the lingering COVID-19 pandemic issues. It's not done yet. Not because we have all our mammoth rallies and gatherings and then getting back to the malls at 80% of foot traffic means COVID is a solved problem. There would be lingering problems of COVID and we will feel it not just now, but in the next 2 years. Logistics problems, supplies issue. There are people, even with the lower or less stricter protocols, they're still not willing to go out. Consumer confidence at this level doesn't exactly match 2019. We are not there yet. And if we're going to be looking at supply and logistics concerns, we might have to see that it will take a little time for us to really get to the level where we were in 2019. But it's not only that. The bigger reason is the war. Quite frankly, it has damaged a lot of value and has brought about concerns regarding commodities, not just in terms of prices, but actual supply. We're also getting issues with regard to inflation and rising interest rates. Basically, if you're going to be looking at what has caused that actual drop, the major part of it will be these three. It's not because of the winning candidate for president. And let me say that I translate that to what we see in our own country. Inflation zooms to a high of 4.9 in April. This is after hitting 4% in March and hitting 3% in February. And quite frankly, I will consider this accelerating inflation. And will it stop? It will be very difficult to say it will very, very soon because of certain things like oil price spikes. If the war continues and Brent hits a high of about 140 or 150 and stays there for a few months, we are really going to be seeing pump prices to hit 100 pesos. So it is something that is out of our control. So much so that I've been, telling some friends, you want the market to go up? Even if the other candidate won, the market will be like this. You know what could have caused it to go up? That is if Putin says, I'm putting a stop to the war and Russia won't invade Ukraine anymore. If there's a coup in Russia and Putin is out and they decide not to attack Ukraine anymore, that will bring global markets up, not just the Philippines, global markets. Because that is my point, ladies and gentlemen. It is not about us. While we think that way, we are but a speck in global finance. If you're going to be looking at the impact of inflation in global markets, we're looking at the Eurozone, OECD, the US, and the world. Even with the potential fiscal response, inflation's total effect globally will be hard felt. And when we're talking about this, we're not just talking about the Philippines. Look at how it is in the US. It's almost like getting back to the level of the oil price shocks in the 70s and early 80s. It's almost like going back to like close to the Korean War and even post World War II supply constraints. That is how bad inflation is. And while we say in the Philippines, we're hitting 4.9, the US is at 8.5. They're at 8.5. We're still better off than them. But the US and the Philippines were still going to be better off than 53 other countries in the world. You know, confirmed double-digit inflation, and these are countries representing 1.8 billion people. So if you're going to be looking at that list, and with the Philippines at 4.9, we are very alarmed locally, but internationally, there are a lot of countries that are reeling and that are worse, in a worse position than us. And the US is reacting. And the reaction of the US is plain and simple. Increase interest rates. That is expected. But the increase done would be, the first since 2000. Increasing rates by 50 basis points in one blow goes back to the year 2000. Successive interest rate hikes from 0.5 to another, 0.25 to another 0.5 is unprecedented since 2006. And if you're going to be looking at US interest rates in terms of what's expected, they're not going to stop yet. They will have to control this and make sure that they stem inflation. And markets are always going to be operating and moving in contrast to the movement of interest rates. And very, very unfortunately, the rise of the 10-year Treasury notes, which we have seen a few months ago, would have showed us that markets will be weaker moving forward. So it's not the Philippines. It is more than the Philippines. It is more than the US. It is a global phenomenon. And it impacts not only inflation, not only interest rates, but GDP. The global impact of the war on GDP hits a level of negative 1.5 almost for the Eurozone, and about 1% from the US, and globally about over 1% as well. So as we would often discuss with each other and say, it's all about our elections, let's think again. Because if you're going to be very factual about it, if it's all about our elections, why is it that the Dow Jones Industrial Average was even worse? We were down 270 points in 5 trading days. In 6 trading days, Dow Jones was down 2,331 points. Why 6 days? Because May 9 was a holiday. That's our election, right? So in the same period, they're down 7%. Is it just the US? Check out the Hang Seng Index. They're also down 4%. So it's, again, reacting to this in a very objective way. It is a pervasive problem that is global in nature. But there were still naysayers. There were naysayers. There were people who said, Boss Rex, why Ayala? Why Ayala Corp dropped like that? Why did Ayala Land drop like that? And before you know it, there were rumors that were circulating. Oh, maybe the Ayalas were yellow. And because, this guy won the election, the new administration will be hard on Ayala companies. It's so easy to jump to those conclusions. And very unfortunately, if you're not abreast with market developments, market information, and fundamentals, you're really going to be swayed emotionally, and your perception will be clouded. And when that happens, rationality goes out the window. Because let me tell you what happened last Friday. Last Friday, the market dumped AC, ALI, and AEV. What drove that? Is it the new presumptive president? Maybe not. Many people don't know this. The MSCI rebalancing has started. And in the MSCI, it is decided that Converge Telephone or PLDT, Monde, and SMPH will now have higher weightings in their index. And much like the PSEI, the MSCI is a set of indices regionally and globally where people have set forth certain allocations and weightings on countries. And our weightings are distributed across some of the names of the biggest companies in the Philippines. They decide. But you see, once they decide that, okay, we're increasing weightings on these companies and decreasing weightings on Ayala Corp, Ali, and AEV, fund managers will have to sell. Fund managers will have to recalibrate. Sell shares of the companies that have been, lowered in terms of weighting and buy companies that have been increased in terms of weighting. And that's exactly what happened. Unfortunately, last Friday, there was no volume. There were no buyers. And if you're going to be selling with no buyers, guess where the prices are going to go? Guess what happened in over a weekend? Where did the prices of AC, Ali, and AEV grow? Where did they go? Let me tell you, as a very experienced stock market practitioner, most issues that are downgraded by the MSCI, they drop once the corrective measures are done, but they increase afterwards. Conversely, those companies that they increase in terms of weighting, they fly over the short term, but over the long term, they go back to their rightful valuation. It's always a law of supply and demand. So if you don't know things like this, you're just going to be whiplashed, and worse, you're going to be thinking about wrong reasons for the way things are happening. And how come this was more like synchronized in terms of results? It's synchronized because obviously the culprit was the rebalancing itself. So let's look at the Philippines now and let's check out the positives. What will go for us moving forward? I think you all know we grew by 8.3%. That's one of the highest ever. And if we're just going to be consistent at 8%, you know where we're headed. The real growth rate of the ASEAN 5, no one gets close to 7%. And if we can make 8.3 our base and even grow from there, then we will have a better foothold into our future. And what's carrying that? OFW remittances up 2%, 8.65 billion in 1 quarter. See, a lot of people think, the global markets are contracting. Economies are slowing down. Ergo, OFW remittances will have to be lower. But they're increasing. And we're not even done with that. The other pillar of our economy that was hard hit, tourism. is going to be on a recovery swing. And why? Because April 1, we opened our doors to all countries. There would be no quarantine protocols anymore. We will just need their vaccination cards, their proof of vaccination, and they can visit the Philippines. Before this opening was done, April 1, do you know that there were 47,000 visitors to the country? February, when the country is not even open yet, we had 47,000 visitors. Can you just imagine what will happen after April 1 when we open our doors to all countries? And to push that point, the Global Summit for World Travel and Tourism was even done here. It was done from April 20 to April 22. That is how the global market looks at the potential of the Philippines as a tourist destination. So very clearly, 2 out of 3 pillars, right? What's the last pillar for that economy? It's our BPOs. And the BPOs, according to the IBPAP, is going to rebound and get down to 29 billion revenues in 2022. So all 3 pillars should be operating positively. But it's not all a bed of roses, ladies and gentlemen. I will just have to be, as I've said, objective and rational about this. What are the downsides? And I guess you see this all over the news. Oh, sorry, I missed out on the last one. The last one is an all-encompassing factor, and that's the reopening of our economy. We're reopening the economy, and that's going to benefit, most of the businesses, and hopefully in a few months, a rising confidence level of consumers will definitely push our companies to even more positive results. But again, as I've said, the negatives, the issues and the concerns. National debt, 63.5% of GDP. They always say the threshold is 60%. And to keep it within 60% of low or lower should be very, very beneficial. I somehow have a mixed reaction to that. While I agree that for a country like the Philippines, we have to control our debt because we're not heavy revenue generators. We are importers. We don't have too much of exports. So for me, keeping that debt at a controlled level is really very important. As I say that though, let me tell people, there are countries that are well beyond 100% of GDP when it comes to loans. The US is one. And if you're not enamored with the US, I will tell you, Singapore is the other country that's like that. What am I saying? To borrow and be on debt, even at a heavy proportion, can be good depending on where you use the money. You borrow and you use the money correctly, you will generate revenues for the future, a vibrant economy that can be stronger and bigger. So certainly, you'll have to look at the way this debt situation goes. And we will have to watch out because certainly if we're going to be continuing build, if we're going to be augmenting our infrastructure and we're going to be helping out in the remnants of COVID, the country will have to continue to borrow. But what we have to watch is where those borrowings are going. We can afford to have a little more debt if we're making sure that eventually this debt will generate more revenues for the future. What are the other concerns that I have? It's the operation and performance of major government-owned and controlled corporations. Not so much in the news, but very, very worrisome. Do you know that the SSS, the losses have increased 99% to 844 billion? The contributions are not following the pace or accelerated disbursements that we are handing out. We have improved the benefit side for the retirees and for the pensioners Unfortunately, for those people who contribute, we were more political in nature and we cushioned the impact. For that reason, it's the institution that's bearing the brunt of it. Even GSIS. I mean, yes, it has narrowed its loss, but it's still losing 18.7 billion in the last year. And I guess I don't have to expound on this, but PhilHealth, which is the cornerstone of our universal healthcare law, will have to be in shape if we are to get down to that direction where our healthcare is going to be on a positive note. So these are issues that we'll have to see. So what are we watching out for? What are we watching out for? Yes, Ferdinand Marcos Jr., Bongbong will be our next president. But instead of just waiting for the things to happen, I'd really like us to be vigilant enough to watch out for what's going to be relevant. Amidst all the exchanges of issues and concerns, what are the real factors to look at? Number one, platform of government and the main priorities of this administration. A lot of us have actually disagreed with the thrust for him not to attend the debates and for him not to be very clear with his platform of government. As a marketing practitioner, this is another story. This might be a full webinar as well, but I can tell you, if I were to advise him, I would have done the same. I would have done the same. See, real platform of government and the main priorities, they should happen when I win. If I stand in stages to talk about these things, most Filipinos won't understand it anyway. And for the people who understand, they're going to be a minority. Even if I win their confidence, I will lose the votes of many. So that's key. Keeping the message very simple. And he was criticized for that. Pagkakaisa, unity, magkaisa. He says that 20 times in like a span of 5 minutes. That works. Marketing-wise, that gets instilled in the minds of people. After you win, get down to the platform. Now, I'm waiting for that. Clearly, I will have to see it because I will understand him during the campaign period. Because during the campaign period, the objective is to win. After winning, the objective is to run the country well. And hopefully, that is the objective of the incoming administration. But the other key factor will be the executive branch appointments. Who will be in the cabinet? We've seen people, being raised and being talked about. But except for a few, all of these names are simply floating. But we all know the cabinet will be running the country. And if you're going to be looking at the way the campaign was run, much of it has been delegated. And for good reason. I would have wanted that to happen. Like if I look at President Duterte, I like his practice of not meddling in the economic team. Why? Because that's not his forte. He let his economic team manage the economy, and for good reason, I think we're okay. So if we are going to be looking at appointees, who are going to be these people? Because they are going to be the ones that probably will direct my level of confidence moving forward. And with that, the appointment of the economic team as well, who are the names here, and the GOCCs. I probably will need to discuss this item a little more later. But again, the COVID pandemic is not yet done. And there are other issues, as I've said, as commodity prices soaring and inflation. So what would be the responses to these critical concerns? On top of a platform that will be geared longer term to a 6-year horizon and even beyond, we will have to look at incoming priorities to tackle outright issues and concerns that exist. But for me, this is major. The choice of people to run an economic team, specifically the central bank governor and the finance secretary, is of utmost importance. No matter the color you had all through the years, no matter how great the president or how good the president would have been, I think you can all translate the economic and investment performance of our country directly with the people who run finance and the entire economic strategy of the country. If you're going to be looking at Fidel Ramos's term, he had the Finance Minister of the Year, awarded globally 3 times. And that's no other than Bobby De Ocampo, a person who I didn't know personally at that time, but I campaigned for because he ran for senator after that. Talo. Talo ng mga artista at ng basketball player. Nakakapanghinayang, but that's the way things are. Pinoy, that was Cesar Purisima. And in the most tumultuous time, the most difficult time in the ERAP administration was when Gabriel Singson would, have to leave because his term ended. And anyone who's going to be replacing him, everyone says it's going to be such a tough job. No one wants to even go to the plate and do it. Until he chose Paeng Buenaventura, somebody who he has asked to be central bank governor years before, but didn't say yes. Took it up and advanced to the plate and fixed the central bank and got into policy reform and left it in stronger hands when he gave it to his successor. I guess I can always say, you guys might be a Duterte follower or a Duterte hater. I wouldn't mind whatever part of the spectrum you're at. But you will have to agree with me that the economic team that ran this game for the last 6 years have done very well given the landscape that they're doing it with. Sonny Dominguez provided a calm to the business community when he got appointed. People know him from the time of GMA and even before that. They know that he's going to run a tight ship. Ben Jokno also served very well as central bank governor, and Carl Kendrick Chua, for as young a person as he is, maybe his youth was really nice for that job. Who are going to be those people in this administration? I will have to wait for that. But as we move on with this uncertainty, with this volatility and uncertainty, Rampver Financials has given out this 5 set of advices that probably we will all have to heed. Number 1 is to manage your emotions. Don't panic. You have to maintain a rational framework for decisions and actions. Do not let irrationality cloud your view and make you hastily get down into decisions you will regret, especially for your financial portfolio. Keep your eyes on the goal. Remember, we are investing to achieve financial goals and dreams. Recognize your risk appetite, recognize the right time horizon. If you're going to be looking back at your goals, the key thing is this. Always remember, financial goals are to be achieved no matter how the environment goes. We cannot control the weather. We control our ship. And that's the reason why our reactions to our environment is much more important than the environment itself. Get your facts straight. And that's the reason why we're very happy that you all attended this webinar. That just means you want the information. That just means you want to be abreast with what's really happening. And at Rampver Financials, as I've said again and again, it's real talk. It's facts and figures, and we will tell you when we're getting opinionated about things. Be well informed And as I've said, many of you, RFFs, don't even have to research. We will be doing this for you. Be open and prepare to seize opportunities. You know, just recently, somebody said this: never catch a falling knife. You know, for most part, I've been in this investment arena for so long. I have heard that statement many, many times, and I've actually refuted it many, many times. Never catch a falling knife. I agree with that. But you can catch falling knives when you're wearing the right gloves. When you're wearing the right gloves. And what's the right glove? It's your portfolio, the management of your own financial world. Think about this. My economy doesn't have to be the outside economy. I have my own economy to manage. And in the worst of times, it is when great value propositions arise. And for that reason, I say to a lot of people, greatest investments happen during times of turmoil, during times of uncertainty. But always review and evaluate your portfolio. Match it up. Check it. Is it aligned with the situation? Is still aligned with your goals? So in so doing, let me share with you inputs on effective portfolio management strategy. At a time like this, watch your cash flows. Make sure you have enough, because if you need to sell because of an emergency, because of an outright need, and the market is like this, you will be losing money. You have to make sure that your allocation is correct. Are you doing the right market exposure? Are you focused on the Philippines, or are you more invested abroad? Quite frankly, this is an opinion, but I know that the Philippines fundamentally is in a much better place than the US. So my weighting will have to be a little more local than international. And if it's international, I'll still go for emerging markets and Asia. How about industry and sector exposure? Think about the industries that will do well in a high inflationary and interest rate environment. Real estate, for example. How about the conglomerates who are well positioned because they're fully diversified? Who are at risk? Manufacturing, construction, processing, companies that rely on factors of production that will increase in cost, and in so doing will be squeezed margins wise. So those are the things to avoid. Currency exposure. Are we going to be solidly in peso, or do we think about having some in other stronger currencies? We know we're now hovering at around 53, and people are saying it might get to 54 by the end of the year. Now, the naysayers will say 60. That might be too much. And if ever it's going to hit that level, maybe you're going to hear it from us. But as of the moment, we will not be saying such, because that is basically a result of people just wanting to scare others. Peso and dollar cost averaging only works if you're invested in the right instruments. Let me tell you, ladies and gentlemen, most of the things I've talked about are not exactly day-to-day feeds in Facebook, in TikTok, and in other social media. We still need fund managers. We still need investment advisors. Please choose well and choose wisely. And for those of you who have chosen Rampver Financials, let me thank you for giving us the honor and the trust. Thank you for recognizing our role in your financial destiny. That is basically my presentation. I will be open to questions, but as of the meantime, we will have to deal with a very robust full program here. I will see you later and will answer questions that you might raise. Maraming salamat po and blessings always.
Wow, thank you so much, Boss Rex, for such enlightening and encouraging talk. So your presentation gave us the confidence and great ideas on how we can best positions our funds during this time. So makikita po natin si Boss Rex maya-maya po ulit, no, for our question and answer portion. And to summarize some important highlights from Boss Rex presentation, here are our key takeaways. So we have here, we are dealing with global concerns, not just Philippine related concerns. And next we have, okay, soaring commodity prices, accelerating inflation, and higher interest rates have been the drivers of weak markets locally and globally. And lastly, we have there are positive and negative in the Philippine economy. So we have to recognize both of them and monitor developments. And lastly, no, it is not about the environment, it is how we react. That is what we can control. It is where actual power lies. And keep your sight on your goals and manage yourself and your portfolio through the tough times. And again, thank you very much, Boss Rex. Okay, so now we're going to introduce our next speaker. So Carlos is currently a portfolio manager in ATRAM and the new addition to the equities team. He was previously the portfolio manager for equities in the trust banking group of Metro Bank and has 8 years of experience in the fund management industry. He holds 2 master's degrees. The first is a master's degree in management with University of Asia and the Pacific, and the second one is master's degree in computational finance with the La Salle University. Friends, without further ado, let's give a warm round of applause to Soldivo Strategic Growth Fund's Equity Fund Manager, Mr. Carlos Navarro.
Hi, everyone. Good afternoon. Thanks for inviting me here, and I really hope you learn a lot from my presentation this afternoon. Thank you.
Hi, Sir Carlos.
Yeah, without further ado, I guess we can start. So from our first slide, the market has continued to recover from the March 2020 lows. So if you remember, in March 2020, the market went as low as 4,500. That is on a closing basis, but on an intraday basis, the market actually went to as low as 4,000. And we are now at 6,600. So that's approximately a 50% gain already from the lows in March 2020. Now, if we zoom into 2022, we can see that the market has corrected lately. As of now, the market is down year to date 8%, and that is due to the following reasons. Number one is high inflation, caused, of course, by the higher commodity prices, which were in turn caused by the Russia-Ukraine crisis. The Russia-Ukraine crisis has disrupted supply chains, and this has caused commodities prices to spike. And this has in turn caused high inflation. So that's one of the reasons why the market has dropped. And the other reason is rising interest rates. As central banks around the world start hiking interest rates in order to combat this inflation. So this hasn't been a recent development, and this has been going on for since March. This kind of correction, this kind of volatility, we have seen this since March. So this isn't just due to one specific event, for example, the elections. This has been going on since March, this kind of volatility, this market downturn, and this hasn't been specific only to the Philippines. This global market correction happened also in Europe, in the US, and our fellow ASEAN neighbors. So to add to that volatility is also we are awaiting for more policy certainty from the incoming administration. So that has also caused investors to wait on the sidelines as we await for more clarity, as Sir Rex mentioned, on the economic programs of President BBM and also the cabinet appointment. So until we have some more clarity on that front, investors will probably stay on the sidelines. So those are the reasons why we have corrected from the 7.4 to 7.5 peak that we had this year. And this is mainly due to, of course, to the macro concerns rather than the policy uncertainty that I have mentioned. Since this correction has been going on for the past couple of months already. But still, despite that, we are still positive on the market because of the economic reopening. This economic reopening is not going to stop. This will continue. A perfect example would be first quarter GDP came out at 8.3%. And this is way above expectations of a 7.1% GDP. We blew away the expectations on GDP. So that's just proof that this economic reopening is on its way and it will continue. And that is the reason why we are still positive on the market. Next slide, please. So just to give you the corporate earnings in 2021, actually corporate earnings for the first quarter of 2022 are coming out already, but they are not yet complete. So what we will show you are the 2021 corporate earnings. So as we can see under FY21 ACT simply means actual. So full year 2021 earnings came in at 47%, with fourth quarter 2021 earnings coming in at 48%. So these are pretty good numbers, but let's focus on the full year 2021 earnings of 47%. Our initial expectation was only an earnings growth of 30%, but the earnings growth blew past away our expectations as it came in at 47%. So this is a pretty strong number. These are pretty good figures that we are seeing. And that just goes to show the continued recovery of the economy as we move forward, as the economy reopens further. So this earnings beat were led by index heavyweights such as SM, Jollibee, AEV, ICT. So those are the companies that have led this earnings estimate. And we expect this decent earnings growth to continue in 2022. For 2022, we are expecting a 17% earnings growth. Now, a lot of you may ask, 17% isn't that kind of low compared to 47%? Well, it is, but we have to take things into perspective. Number one, we are coming from a high base. So that's the first one. And the second one is, of course, there are current concerns right now in the market. High inflation, higher commodity prices, higher input costs will affect the margins of companies. And that is why, aside from coming from a high base, this higher input costs, this higher commodity prices, that's also another reason why we are expecting a lower earnings growth for this year. But still, 17% earnings growth is still a pretty good number. And the reason for that is this higher commodity prices, it's affecting all countries around the world. And 17% earnings growth is actually pretty good, especially in the ASEAN region. In the ASEAN region, Vietnam has the highest earnings growth at above 20%, but we are actually in second place already at 17%. So if we put things into perspective, we're actually in pretty good stead. We're in good company. We have the second highest earnings growth for 2022, despite having higher commodity prices. So we must always take things into perspective and not look at the absolute number. We must compare how we're doing compared with our ASEAN neighbors. And we are actually doing pretty well since we have the second highest earnings growth for 2022. Next slide, please. Now, we want to have a checklist. Sir Rex has already mentioned this a while ago, some of the things that we have to watch out for. The details that we need for the incoming administration. So I would just like to give a little more color on what we need for the economy for the next 6 years, because this will affect the stock market. So first this is our checklist for the new administration. Short-term concerns. Number one is inflation. As we all know, I guess it's pretty obvious already, oil prices are really high right now. Everyone knows that already. So what will the government do to address this? Are they going to waive the excise taxes? Or are they going to do conditional cash transfers to those people who need it the most? So that's one thing that we are waiting for. That's one thing that we should monitor, because this will really affect not only the economy, but this will affect all of us. And the second one will be the secondary effects of high inflation. Transportation, the transport fare hikes, food. I guess, again, all of you already probably know this. You go to the supermarket, the canned goods, everything, wheat, flour, milk, they have all gone up in prices already. So how is the government going to address this high inflation? Again, this is not only for the economy, but this is for us consumers, because we are the ones who are being affected by this high inflation, high costs across the board. So how will the government address that? That is something that we should also monitor. And next will be the COVID recovery plan. So this one, number one, we have the BPO wish list. The BPOs are an important part of our economy. They want a hybrid work arrangement. A lot of them want to work from home. I guess probably a lot of you also prefer to work from home. So that's one of the wish lists of the BPO sector. So let's see how the government will address that. And the next is unemployment. Unemployment has actually been improving. But I guess the question is, how will we sustain this continued improvement in unemployment? So also GDP has also been improving. As I mentioned a while ago, 8.3% GDP for the first quarter of 2022. Very, very impressive, very strong numbers. It was way above expectations. So I guess the question now is, how will we sustain this momentum? How will we sustain this recovery? Now, next will be the long-term issues that we need to monitor. So macro concerns. Sir Rex mentioned a while ago about the debt to GDP, and I'm also going to mention it again. This is important. So debt to GDP is currently at 63.5%. So that limits our ability to borrow. But of course, that doesn't mean that the government can spend. If we borrow and it funds projects that will earn good returns, that will contribute to the growth of the economy, then that's good. So how will the government manage these high levels of debt? Because, for example, the International Monetary Fund, they prescribed a debt to GDP ratio of 60%, around 60% for developing countries. So we are slightly above that. So it's good to monitor on how the government will manage this debt to GDP ratio, how they will bring this down. The next will be the fiscal deficit, or to be more specific, the twin deficits that we have. We currently have a current account deficit and a budget deficit. So that's something that we also have to monitor. Now, the next, I think, more importantly, what the fiscal policies will be moving forward. So that's another long-term issue that we need to monitor. For example, continuity from the Duterte administration. We have the infrastructure program, the build. So BBM has already expressed that he will continue this infrastructure program. And I think that's good for the economy, because this is what we need to improve our infrastructure. So the only question is whether they will go the route of President Duterte, where the government fully funds these projects, or will they go the route of the Pinoy administration, the PPP, or the public-private partnership, where there's a partnership between the government and a private corporation, and they will undertake the project themselves, the two of them, those two parties. So there are pros and cons. The cost of funding will be lower if the government takes it on, and it will also be faster because there are less parties involved. But on the other hand, we have high levels of debt. So if we want to avoid taking in more debt, then probably the PPP route is an option for the incoming administration, because it alleviates the need for the government to take on more debt, because you have a private corporation that will help you in funding that project. So there are pros and cons. So we have to await more details on how the government will actually implement this infrastructure program. But nonetheless, I think that this infrastructure program is is important because we really need to improve our infrastructure as we are lagging already behind our ASEAN neighbors when it comes to infrastructure. We just hope that the choice, the way we execute the infrastructure program will be logical and will be sound, and that also takes into consideration the debt levels that we had, because we have high debt levels already. And we want, of course, to improve that. The next will be tax reform. The Duterte administration has already lowered personal income taxes and corporate income taxes. But there are a couple more tax reform packages that are still in line. So will the incoming administration, will President Bongbong continue those tax reform packages that haven't been passed in the Duterte administration? That's also another thing that we have to monitor. And the next will be lower foreign ownership limits. We have bills that were passed during the Duterte administration which lowered foreign ownership limits, which is very good because it encourages foreign investments in our country, which we badly need in order to improve, especially the infrastructure of our country. So just an example of the bills that they passed, we have the Public Services Act, we have the Foreign Investments Act, and we have the Retail Trade Liberalization Act. So those three bills have lowered foreign ownership limits basically on the economy itself. So we are hoping that the incoming administration will capitalize on that in order to attract more foreign investments in our country, especially since we need that as we continue to recover from the pandemic and as we are currently battling high levels of debt. These foreign investments will definitely help us improve and even accelerate the infrastructure program that hopefully President BBM will also implement as continued from the previous administration. The next will be digitalization. The national ID is there that will kind of speed up the bureaucratic processes of some of our government applications. On the simple side, we don't need two IDs anymore. The national ID is supposed to solve that. We only need to present one ID only, and that's supposed to be the national ID. But there are, of course, a lot more positive effects, and one of them will also help for the financial inclusion. There are a lot of unbanked people right now in the country, and whether it will be through e-commerce, through e-wallets, financial inclusion is definitely something that is important, and digitalization will help bridge that gap. So that's also one of the initiatives of the BBM administration, and we are hoping to get more clarity on that. And the new policies. We have agriculture modernization. Now, that one, I think it's very important. And this is what one of the programs that BBM has stated explicitly. And this is, I think, we need more of this because, for example, in Vietnam, they are already using a lot of machineries. And for us, there's still a lot of manual labor in terms of our farming techniques. So this modernization of our farming methods is definitely important since it is a big chunk of our economy, the agricultural sector. And a lot of people are employed by the agricultural sector. So as we modernize that, again, that is something that we must do, and that is something that we actually look forward to. So we want to get more details also on that, the new policies regarding agricultural modernization. And the next will be SME support. Probably 90, close to 100% of almost all of the businesses registered here in the Philippines come from the SMEs. So President BBM has said that they will continue to support the SMEs. Now, again, we want more details on that. That is something that we want to monitor because how are they going to do it? Will it be through tax incentives? Will it be through loans, through the government banks? There are several avenues for that. So that's something that we also have to monitor. And lastly, renewable energy. Renewable energy, I think it's really the future. It's not dirty. It's good for the environment. It's good for our health. and it is more sustainable. And the cost of producing renewable energy becomes cheaper and cheaper as time goes by. That's why I believe that I think all presidential candidates have expressed the need for renewable energy. And I think that is the way to go. So we must also consider what the plans are of the government concerning renewable energy, because I believe that this is very important in order to achieve energy security in our country. So it is an exhaustive list, but these are the things we definitely have to monitor, because everything that is on this list will determine where the economy will go for the next 6 years. Guys, 6 years is a long time. So we must always be vigilant. We must always monitor these programs that the government has, because this will determine our future, our economic future. And whatever will happen to the economy, it will also happen to the stock market. So these are the things we definitely have to monitor for the incoming administration. Next slide, please. Now, we want to discuss the sectors that we like in this market right now. And we like the banking sector. On the upper left chart, we are showing you what we call the price to book ratio. Now, to explain the price to book ratio, it is simply a metric that we use in order to determine whether banks are cheap or are expensive. So right now, as we can see here, of course, the higher the figure, the more expensive it is, and the lower the figure, the cheaper it is. And right now, the figures are low. The price to book ratio is low. It simply means that banks are already very cheap right now. And this is despite the fact that some of the banks have outperformed the stock market this year, but still, despite that, banks are very cheap. So that's one reason why we like the banks. Another reason why we like the banks will be loan growth. On the lower left chart, we can see the blue line on the lower left chart. We can see that loan growth continues to improve. Loan growth is currently at 8.9%. This is as of March. And this came from a loan contraction of -5% in June of last year. So we can see the big improvement already in loan growth. So loan growth is expected to hover at around 8 to 12% for this year. So this is a big improvement already for the banks, because loan growth last year was just relatively flat. Now we're expecting 8 to 12%. So that's something that we look forward to for the banking sector. Next will be the bad loans, or the correct terminology of this is actually non-performing loans. But we can simply call it bad loans because that is what non-performing loans are. They have already peaked in 2020, 2021. And now we expect these bad loans to decrease in 2022 and to decrease even further in 2023, 2024 as the economy continues to improve. Asset quality is better. Now, there is less need for banks to provide for bad loans. They need to set aside less money for the bad loans, which is good. Because if we set aside less money for the bad loans, it means that your earnings, the bank's earnings, will go higher. And that is why it is positive for us to have less bad loans. And that is what we are seeing. There's less defaults, less bad loans, better asset quality for this year. Next will be higher lending rates. Now, this is also the reason why we like the banking sector. And this is the last reason why we like the banking sector. Unfortunately, of course, for us borrowers, it is something that we don't look forward to, because if we want to borrow money, we want to borrow at a lower rate. So unfortunately, that's probably not going to happen anymore because of the higher interest rate environment. Lending rates will now become higher. So while it is of course unfortunate for some of us who are borrowers, this, on the other side of the fence, this will be good for the banks, because this is how banks earn. They loan out money at a lending rate. So the higher the lending rate, the higher their earnings will be. So That is the reason why we like the banks. In a higher interest rate environment, lending rates will become higher, and this will improve the earnings of the banks. So just to give you a sensitivity analysis, if the BSP hikes rates by 25 basis points or 0.25%, the net interest margins of the banks will improve, will go higher by 8 to 12 basis points. And this will improve an average 2%. So the main message here is higher rates, higher interest rate environment will lead to higher lending rates for the banks, which will lead in turn to higher bank earnings. So those are the reasons why we like the banking sector. Next slide, please. Now we go to the property sector. Let's first focus on the left chart, on the left portion of this slide. We're talking about the malls. Now, the malls are probably the most immediate beneficiary of this economic reopening. I guess a lot of you have noticed this because malls have been jam-packed, especially on the weekends. Malls are full. It looks like we're back to normal already. So as you can see on the left chart, the foot traffic in malls are at 70% of pre-pandemic levels already. Now that is a big jump from only 40% foot traffic in the previous quarters. These figures are as of fourth quarter 2021. But if we look at 2022 figures, on weekdays, foot traffic is already at 85%. And on weekdays, there are some malls that are 100% foot traffic already, 100% of pre-pandemic levels already. So you can see that things are starting to go back to normal already when it comes to the mall segment. And of course, we want higher foot traffic because the higher the foot traffic, the higher the tenant sales. Basically, mas marami kang benta because we have more people coming in the malls. So tenant sales are expected to improve from 80% of pre-pandemic levels in the fourth quarter of 2021 to 90 to 100% already of pre-pandemic levels in 2022. And in turn, you have more people coming in, you have higher tenant sales, it will also lead to higher mall revenues. And mall revenues are expected to reach 82% of pre-pandemic levels already in 2022 from only 50% in 2021. So that's how the sequence goes. Higher foot traffic, higher tenant sales, which will lead in turn to higher mall revenues. So that's why we like the property sector. That is one segment, that is the mall segment. Now we go to the next segment, the residential segment of the property sector. That is on the right portion of this slide. The residential pre-sales, or what we call the reservation sales, continue to recover in 2022 and expected to reach 300 billion. Now, this is a big increase from only 250 billion in 2020. And we expect this to reach pre-pandemic levels already by 2024. Another thing would be construction capacity. Construction capacity is at 80 to 90% in the fourth quarter of 2021, and we expect this to reach 100% already of pre-pandemic levels by 2022. Now, the reason why construction capacity is important is it will improve the margins of the property developers. They will be able to launch more projects efficiently and faster, and this will be accompanied by an improvement in the demand for these projects. These projects, I'm referring to the condominiums, the houses that the property developers are developing. And the accompanying improvement in the demand for these projects are coming from the fact that the economy is continuing to recover already. And this will lead to an improvement in the demand for these project launches. So those are the reasons why we like the property sector. First, the residential segment. And most importantly, actually, this is the bulk of the reason why we like the property sector. It's really the mall segment, which we believe will deliver one of the highest earnings growth for this year. Next slide, please. Now, for our outlook, we are targeting for the PSEI 7,800 for year-end 2022. Right now, if we look at the market right now, it closed at 6,000, around 6,600. So our target is 7.8. That is an 18% upside from current levels. And now that is based on a 17% earnings growth and a 19.1 times price to earnings ratio. Now the 17% earnings growth, that's what I have already mentioned a while ago. We're coming from a high base last year, and the margins of the companies will be affected due to higher commodity prices. So we will have a lower earnings growth compared to last year, but still good enough to give us a 7,800 target for this year. Now, for the price to earnings ratio, we chose 19.1 times, which is below the 10-year average. Now, the reason for that is to take into account the risks right now in the market, the concerns. Of course, higher commodity prices, I've mentioned that several times already. That's something that we consider. And also the new COVID variants. I think this is less of a risk now because I think we are at the point, I hope I'm right though, we are at the point that we are turning from a pandemic into an endemic already. So probably this is a less of a risk already, especially since the high vaccination rates of our population. So those are the headwinds in the market. Those are the concerns in the market. And also expect low volumes in the market as investors wait for more certainty, for more policy certainty on the economic policies of the incoming administration and also the appointments, the very important appointments, BSP governor, the secretary, who will the secretary be of the Department of Finance. These positions will basically determine where the economy will go. So we are awaiting for those cabinet positions. So those are very important. And once we get more clarity already on the economic programs of the incoming administration, then we expect more active interest already, especially from foreign investors. Now the tailwinds or the things that are going for us in the market, of course, as I have mentioned, the reopening story. Again, GDP at 8.3%, that is just proof that the economy is recovering. And we expect this GDP growth, these kinds of numbers to be sustained in 2022 in the succeeding quarters. So that is the single biggest factor. That is why we are still positive in the market. It's really the reopening story. There is no stopping the reopening story. And that is the reason why we are still seeing upside in the market. And also, another tailwind would be the post-election relief rally. The post-election relief rally, the reason for that is historically, the stock market has always delivered positive returns 12 months after the elections. A perfect example of that is ever since 1992, we took a look at the performance of the stock market 12 months after the elections. And going back to 1992, the market has always delivered positive returns 12 months after the elections. And the average gain is 21%. So pretty strong figures backing a post-election relief rally. Of course, there are concerns right now. So we might not get the 21% average gain that we had in the past 5 presidential elections. It will probably be lower than that. But the point is, we are still expecting a post-election relief rally once we get more clarity already on the economic policies of the incoming administration. That is why we are really looking forward to get more details on that, because the sooner that we get details on his economic platform and the cabinet appointments, the better it is not only for the economy, but for the stock market as well. So that would, is there a next slide? Oh, okay, there's a next slide. So just to discuss some of our funds, these two funds, first to start off, the Philippine Equity Opportunity. So this is the fund composition as of March 2022. So if we can see on the middle chart, the largest exposure would be the property, and then the holding firms, and then the financials are next. We are actually overweight on the property sector and the financial sector. So these are our largest holdings. We have SM Prime Holdings. Again, I've mentioned a while ago that we are very bullish on the mall segment. And what is the biggest mall operator in the country? It's SM Prime Holdings. So that's one reason for that. And Ayala Land, of course. Ayala Corporation at 10%. We have BPI next, SM, BDO, and so on and so forth. So this is the Philippine Equity Opportunity Fund. Next slide, please. Now, this is the Soldivo Strategic Growth Fund. For our top 10 holdings, again, we have this pretty much the same names, but different weights, of course. We have Ayala Corporation, we have SM Prime Holdings, we have Ayala Land, we have Bank of the Philippine Islands, we have BDO. So if you look at this relative to the PSEI weights, we are overweight generally on the property and the banking sector. Because as mentioned earlier, these are the sectors that we like. Therefore, we want to overweight these sectors because we believe that these sectors, these stocks are representative of the reopening story, and they will be relatively more resilient in a high inflation environment compared to other consumer stocks, for example, such as URC or Mondenissen, which will be more affected by higher commodity prices. So we believe that we are well positioned in both of our funds to be resilient in this high inflation environment and at the same time to be able to ride the reopening theme. Next slide, please. That would be it, actually. So thank you very much for listening in. And I would be more than happy to answer any of your questions later on. Thank you very much.
Thank you very much for the very informative discussion, Sir Carlos. It's good to know that there are still great products so we can look into and consider amidst times of uncertainties. So to share with you the key takeaways from Sir Carlos' presentation, we have here short-term concerns, but economic recovery is still intact. And good upside to our 7,800 for 2022. And lastly, preferred sectors and banks and property. So again, thank you so much, Sir Carlos. Everyone, please feel free to drop in your questions for Sir Carlos or Boss Rex at our Q&A box so he can answer them live afterwards. So at this point, may we now request our two guest speakers to please open your videos as we now move on to our question and answer portion. So as mentioned earlier, we have chosen the most interesting questions in our Q&A box, and these will all be answered live by our two speakers. So to start with our Q&A session, the first question is for Boss Rex. So the question is, what's your interpretation with the investors that are pulling out and BPO companies that are shifting the resources to another nation? How will that affect the confidence in the economy?
I guess I'd really like to answer that question. But first of all, Kim, let me beg the indulgence of our audience. No, first of all, I really like to thank Carlos for his participation in this event. Carlos, thank you so much for that presentation. Really a lot of insights there. And I guess I'm grateful that our partner ATRAM not only manages our funds well, but also support us for great endeavors such as this afternoon's webinar. So, Carlos, thank you. Thank you very much. Focusing on the question, I don't know which or where the data came from, Kim, no? But per our discussions with many of the real estate consultants, no, predominantly Lichu and Associates and Lobian, even with Colliers, no, there is a lot of information that the BPOs are actually increasing their commitments for this year. In fact, there have been new take-ups of some office spaces. So some part of it I probably won't understand where it's coming from, but quite frankly, the BPOs are on a growth trend. Actually, we're still second to India. I think there was a lot of rumor that because Mr. Marcos won, that a lot of BPOs are going to be leaving. As of now, there's still rumors because per our factual check, the demand for office space coming from BPOs would be up for the first quarter. I have yet to see that go down first before I really get to believe the said rumors. Thank you.
Thank you very much for that detailed answer, Boss Rex. So I hope that answered the question for our viewer. And we have here a question for Sir Carlos. What is the implication of the JP Morgan downgrading the Philippines?
I think that's more of addressing the macro concerns of our country. Again, currently we have twin deficits. I probably, just to give it context, I know I've been asked this question a lot, and I guess the reason why they were very interested in it came on, I think, May 10, the day after the elections. It came on May 10. So some people are probably thinking that it's because of the elections.
Mm-hmm.
But I've read the report, and the reason for the downgrade is really the macroeconomic factors. Mainly, we are vulnerable to higher commodity prices because we are an oil importer. We are an importing country. That's one. And we also have twin deficits. We have current account debt. We have a current account deficit, and we also have a budget deficit. On top of that, we also have a high debt to GDP ratio. So I think those are some of the concerns that JP Morgan has stated. That's why they are underweight the Philippines. Now, whether we deserve that underweight rating, of course, that's up for debate, because I think those are solvable problems, and we just came from the pandemic. So having a high debt to GDP ratio is understandable because we're in the same boat with the other countries. So I just want to address that yes, we have been downgraded, but these are due to macro concerns. High inflation, we are a net importer of oil, our twin deficits, and also high inflation, twin deficits, and also our exposure to a weakening peso right now, which we are seeing. So I think those are the concerns that JP Morgan has stated.
Thank
Kim,
you for that.
I really like to put in my 2 cents worth on that one. Carlos's answer is perfectly correct. That's the real view on it. But let me deal with the emotional part. No, a lot of people really felt it was because of the elections. Again, the timeliness of such a release. And the thing I really worry about this is that it got passed on into groups on the Viber threads, right? And all people read was the cover where you have the picture of JP Morgan and it says, downgraded to underweight. Nobody even cared to read the whole thing. If you're going to read the whole thing, there was nothing there said about the elections. Nothing. Not a mention of the election. So apparently, that could have been released whether the elections happened or not. That's one point. Second, that's a call to underweight the Philippines. That is stocks. I would be more worried if Fitch would have downgraded us, because that will impact our credit rating. That will impact the price that we're going to be paying on our loans. That will have a greater effect on the country. So the fact that JP Morgan calls an underweight, that's more for the stock market. And as Carlos said very aptly, that's a prerogative of, it's an investment view. But Fitch is very different. It's a rating on the country. It's a rating for the way they see our risk moving forward, the way we will be paying our debts. So I'd really focus more attention on that one, because if that's going to be negative, that's going to be worse. It's just that surprisingly, it was positive. It was a pleasant surprise. I don't know where it also came from, but somehow people related this to politics, which shouldn't be.
Thank you for emphasizing that, Boss Rex. And we have here another question. This one's for both of you. What's the worst case scenario that can happen to our market with the election sentiments, Russia-Ukraine war, rising prices of commodities, and interest rates? So how will the growing Philippine debt affect the investment? So that's 2 questions. So
Carlos, if you please answer that. You're the fund manager. I'm just
Sure, of course. Of course, sure. Now, the worst case scenario. Now, for the elections, I guess the worst case scenario would be this continuation of policy uncertainty. Now, that's something that would not be welcome, especially for foreign investors, because the reason why no one has been buying up the market during the last week's market rout is because of the macro concerns and also the policy uncertainty that we will have with the incoming administration, since there's not much clarity on how he will operationalize these economic programs, these economic campaign promises that he made. So I think that's the worst case scenario for him to delay for President-elect Marcos to delay in giving out the details of his economic policies. And also, it is much better if he appoints the cabinet members as soon as possible. So the only point here is really policy certainty. Foreign investors want to know what will happen to the economy in the next 6 years. And as soon as they know that, they will be able to make a decision sooner whether they will invest in the Philippines or not. So the worst case scenario will be a delay, a postponement in clarifying the economic policies in the cabinet members of the incoming administration. I don't think that will happen because if you look at the past several administrations, they have been able to address this in 2 to 3 months once they are elected already. Especially, we will have a SONA already. I think the SONA will be in July, if I'm not mistaken. So I'm hoping we will get more clarity from there, and I believe we will get more clarity, especially during the SONA. So that is possible, but I think it is really unlikely based on historical precedents. That really has not happened, and it won't do BBM any good to delay these releasing the economic policies, the appointment of the cabinet members. It won't do him any good. So I think it is as a possibility, but I think it is unlikely. Now, the next question will be the Russia-Ukraine tensions. Now, that's something that's a lot harder to determine because that is something that's out of our control.
Yeah.
We are hoping that the Russia-Ukraine tensions will settle down, and that is the base expectations that it will only be limited to Russia-Ukraine tensions. It will not expand to other countries, and that is the base case scenario. So that is something that will hopefully calm down the markets. And the next will be the last thing that you mentioned was high inflation. I think the high inflation can be addressed, and it's being addressed already by the global central banks. They have been hiking interest rates. The BSP has sounded off that an interest rate hike is possible already in June. Some are even expecting an interest rate hike by May. Why? Because GDP growth is present already. If you have strong growth, then you would be more comfortable in hiking interest rates. So my point is, I don't think inflation will spiral out of control, because that is the worst case scenario. Why? Because central banks are doing something about it. Our central bank is doing something about it, and he has specifically mentioned that an interest rate hike is looming already. 50 to 75 basis points, probably in 2022 and 2023. That's something that he has, Governor Jokno has specifically stated. So I don't think it will spiral out of control because it is currently being addressed already. So the worst case scenarios, of course, these are all possible. But if we think about the worst case scenarios, we will never invest in the market because we will always be scared, right? So the likelihood of that happening, I think, is low. So it's best not to focus on the worst case scenario because personally, I think it is unlikely for those things to happen.
Thank you. You might want to add for that, Boss Rex, or we're going to...
No, I'm very satisfied with that answer. I guess all told, I wouldn't take the pessimist view, not at this time. There are other factors that I'm looking at that would probably cushion the effect of the bad things that are happening to the global front.
Thank you, Boss Rex. And speaking of the interest rates, no, and we have a increase of REITs this time. So we have here question from our attendee. With the expected further increases in interest rates, would you still recommend investing in REITs?
The answer is yes. Again, it's all a matter of matching it with objectives. I wouldn't be too, opportunistic when it comes to REITs. The attitude I have on REITs would be much like treating it like a fixed income instrument. So if I'm not earning 7% or 6% from the bank, net of tax, then I'd rather be on a REIT because the REIT will be paying me such a rate, and it can also be an inflation hedge as it owns real estate properties. But I'm not going to expect the REIT to fly when the market improves. I mean, essentially, that's the way it operates, right? So if cash flow is my priority, I would go for high dividend paying stocks. And I'm just not talking about REITs. I'm talking about other utilities out there that might also be good dividend paying propositions. No? So for me, it depends on your perspective and the objective that you have in taking the instrument. So quite frankly, I am invested in REITs because I'm happy with the rate where it is right now. In fact, if you're going to be looking at a REIT, it has gone up to 52. It's below 40. So the yield is going to be at a level where it suits me. Plus, I know that it will have accretive power in the future as Ayala builds it up and tucks in new projects and new offices and buildings into the REIT. So it's a progressive game. It's not going to be pretty static as much as other propositions are, like the fixed income instruments that come from banks.
Thank you, boss. Thank you. Sir Carlos, you might want to add, or we can continue with the next question.
Yeah, I agree with Sir Rex. I think it really depends on the objectives of the investor. If you're happy with the yield, if you have cash flow requirements, then REITs and high dividend yielding stocks are the way to go. So yeah, what Sir Rex said is perfectly correct. I agree with him.
Okay, thank you. Thank you for that. And we have here, actually, a lot of our investors are asking about this one. This is about Soldivo strategic performance. So on the side, our Soldivo Strategic Growth Fund has not grown from IPO, which is October 2014, and its NAVs continually goes down. We have lost 8 years of potential growth up to when do you advise I hang on or do I bite the bullet and accept my paper loss?
Okay, I'll take this on, Carlos, and if you can chime in after me, I'd really appreciate it. As my view is going to be very different. No, as a fund sponsor, I really have to look at how we position this whole thing. Remember, we launched the fund in October 2014.
Yeah.
That was a time when the market was at about 7,200, right? 8 years later, 7 years later, we're at 6,500. So if you're going to be looking at that, we practically lost that swing. But always remember, from 2014 to 2018, the market went up to the 9,000 plus level. And that happened in January 2018. So you're building up the funds. And in the first 4 or 5 years, you're actually buying stocks at a high price as the market was going up, quite frankly. So in 2018, I don't think there was a problem with Soldivo going beyond its IPO price at that time because the market went up beyond 9,000. Unfortunately, from 9,000, it has slid back to 6,005. What does that mean? We built up the funds as people invested at higher prices because it was going up. Now that the price is going down, the markets are going down, certainly there are like asset price corrections, and that's the reason why the price of Soldivo is lower. Now, my contention is this. The question we have to ask ourselves as investors, because much like all of you, I'm an investor in Soldivo funds. And quite frankly, I can step forward and say, I probably would have invested more in Soldivo than any of you, quite frankly. I can say that with all due authority. But this is my point. If I sell my Soldivo shares today, that just means I'm selling Ayala Corp below 700. I'm selling Ayala below 30 pesos. And I'm selling SM Prime below 37, which is something I wouldn't do. In fact, if Ayala land is below 30 pesos, I'll be a buyer. So the question I ask myself is, will I buy or sell today? Will I be a buyer or a seller in a market today? And the answer that I have ringing in my head, obviously, is that I'm going to be a buyer. That's an opportunity at 6.5. And we all know it came from 9,100. So my contention is, if I'm going to be a buyer today, why will I get out? The fund by itself is already the fund positioned in all of those instruments. By taking money away, you're actually taking money from a pool that's already trading at those prices. You're not even building up the fund anymore. And if ever we're all putting money into the fund, and, Kim, this. Last week, I've been telling people, I myself put new money in the fund, right? Why? Because as I've said, if I'm not going to be a seller, I'm going to be a buyer. So it's almost like I'm buying Ayala below 700, Ayala Corp. I'm buying Ayala Land below 30. And if I'm going to be looking at this in 3 to 5 years, I probably would expect prices to be very different. Now, I don't know, Carlos, but when I get to look at markets, especially the Philippine market, the swings would probably go 5 years. It's just that this whole thing, because of COVID, got extended a little bit. I would have hoped 2019 could have continued, where 2022 could have been a challenge to the 9,100, if you agree with me. But COVID happened, so we're back to a different chart. We're back to probably a different trend. But that trend is now going above regular trend, right? Because we're trying to catch up. So to sum it up, I have to remember that if I sell today, I'm selling the portfolio as it is. It is not the portfolio that still needs to get built up. In fact, if people are putting money today, they are buying the market today. If you're going to be looking at what Carlos has showed us with the kind of weighting that all those stocks are having in our portfolio, it's buying those at prices today. If you're a seller today, you're the one on the other end. So if I'm deciding that I'm not going to be a seller, then I could be a buyer. So the way to deal with this, again, as I play the long game, in a crisis situation, in a volatile situation, uncertain situation that we have, I'd rather always focus on the long game. Now, people would probably feel, 8 years is already a long period. Unfortunately, guys, I started this when I was in 1983, right? So if you're going to be playing the long game, think about it. In 1984, PLDT was at 350. 3 pesos 50 cents. Okay? So that's the kind of long game I play. Now, when we started buying PLDT, it was 11.50. So I was down 30% to 30%. From the 100% that I bought, I was down to 30%. But I played the long game. Today, PLDT is what? Over 1,800. It's even down today at that price. But if I was already able to buy it at 350, I don't think the price will go back to that level, right? But hey, I've been there and I've been invested, over 50 years, right? So not exactly 50 years. That was like 84, right? So 38 years, right? So if you are looking at long-term objectives, let's be focused on that perspective that plays out on the long game. Because I get to ask people, why did you do this? It's for your retirement. It's for your, child's education. I mean, are you really about to retire? Do you need the money? See, if you need the money, I agree. There wouldn't be any better reason to sell if you need the money. But if you are selling just because you're disappointed and frustrated, then somebody out there will be taking the opportunity to buy your shares. Because that's exactly what happens in markets. That is where, the balance of where you separate real players from the boys happen. And that's the reason why at Soldibo, we'd like to tell people, hey, we're with ATRAM, we're with Phil Hagedorn, we're with Carlos. I mean, they eat this for lunch. They're not going to be emotionally attached. It's a job for them. So I'd rather put my bets on them than some emotional guy reacting to a difficult market situation. So I don't like me when I'm like that. So I'd rather give my money to other people. So that's the cue that I have. Carlos, if you may, I mean, what's your view on this?
Yeah, thank you. Now, regarding that, I'd like to echo what Sir Rex has mentioned. I guess we really have to practice emotional discipline. Remember that we are just starting to recover from the pandemic. Pandemic was in 2020. Of course, it spread out into 2021. That's why we were flat. Last year, the market was flat. So the recovery is just starting. Are we going to sell just when the economy is about to recover? I think the timing of that would be unfortunate if you sell now because the recovery is just starting. Now, again, as to what Sir Rex mentioned, if we didn't have emotional discipline, we would have sold when the market was at 4,500 in March 2020. But look at what happened now. It's a 50% gain from the lows in March 2020. And we have a long way to go. The recovery is just starting. The all-time highs were at 9,000. I don't want to preempt anything, but we will go back to those all-time highs in the future. So I think it's better for us to be buyers right now. Valuations, for example, if we want to talk about the price earnings ratio, it is almost we're way below the 10-year average in terms of valuations. So we should be buying now instead of selling. I think we should practice emotional discipline. I know it's probably hard for you if you invested in 2014, but the market has really been volatile. It's really a function of how the market has performed. But right now, it's definitely not the time to sell because we are just starting to recover. And we are very cheap at these levels already. A perfect example, our internal target price for Ayala Corporation is 1,245. And right now, Ayala is trading at 675. That's almost a 70% gain. Are you going to sell when there's a 70% gain about to be reaped, for example, in Ayala Corporation? So that's just one example. And a lot of the stocks have massive upside potentials just when we are just starting to recover now. So I think now, to echo what Sir Rex has said, I would definitely be a buyer rather than a seller.
100% agree. And thank you for that question, for that answer. And for now, so will be last 5 questions. So we have here one, since we have investors who are diversified, both local and global. So we have here the question: the US economy went down by 1.4% for first quarter of 2022. If this continues for another quarter, then the US will be in recession. What will the effect of this be in the Philippine economy?
Okay. Now, I think that has been partially discounted already. That is the reason why the markets in the US have been down. Actually, they have declined a lot more than us. The declines in the US are probably hovering around 16 to 20% already, while we're only down year to date by around 8%. And that's the reason why the market has been correcting in the US. And that's partly the reason why we have also corrected. But I just want to say that while this might have an effect on foreign investors, of course, if there's a recession in the US, if the US sneezes, everyone catches a cold because of how big the US is. Now, of course, there will be an effect globally, but we will be relatively more resilient. Now, why is that? Because 70% of our economy comes from consumer spending. It's not export oriented. Like, for example, like Indonesia, Malaysia, it's not export oriented. We are driven by consumer spending, and that's 70% of GDP. So while that may have an effect on us, we will be relatively resilient, more resilient compared to our other neighbors in Asia, simply because our GDP is internally driven. 70% of our GDP comes from consumer spending. And with the economic recovery that we are seeing right now, I think we will be relatively resilient. Again, that doesn't mean we won't be affected. We will be just relatively more resilient compared to our neighbors.
Thank you. Thank you for that, Sir Carlos. And last four, so another one, what particular industry sectors could possibly go up under BBM administration?
Well, we have to focus on what his campaign promises are and his economic where he will be concentrated on when it comes to his economic policies. He has specifically stated that he wants to build up infrastructure. So of course that will benefit the property developers, because as you build up infrastructure, that is supposedly supposed to drive up property values. So that's one. He has also specifically stated that he wants to help tourism. And of course, when you help tourism, that will also benefit the property sector, especially those that have exposures to leisures, resorts, hotels. So you have SM Prime and Ayala Land for that. So those are some of the things I think that will benefit from his economic campaign promises. But I guess it will be better for us to wait until we get more clarity regarding his economic policy, so that we could make a more concrete decision on what specific sectors will benefit. But as of now, it will probably be the property sector, given his economic focus on tourism and also infrastructure. And also, just to add, I think to move beyond the BBM presidency, we should look at really where the economy is right now, what state we are in right now. We are in a rising inflation environment in an economic reopening. And as I've mentioned a while ago in my slides, the banking and the property sectors, I think regardless of where BBM will focus his economic policies on, will be a beneficiary of the economic reopening and the rising interest rate environment. It will be the banking and the property sector.
So by saying that, Sir Carlos, do you recommend that banking and the property sector would be the best, best product, or where the clients were in, they're looking for just short-term positions, could put their money into?
Yes, we're not only there for the short term, but I think for the long term, the banking and the property sectors are the way to go. Yes.
I have to mention this, Carlos, no, and Kim. Again, as I've promised earlier, when it's an opinion, I have to say it's an opinion. So this is not factual. It's my own read. We're in a situation where there's increasing commodity prices, right? And we're also into a high debt environment where the Philippines would be at 63% of GDP. Ergo, we're looking for revenues. If we're going to be very serious about it, and if I know, some people around BBM, the mining sector might be one of the good places to be looking at as a dark horse, because the mining sector has been, sleeping over the last decade. For the whole term of Pinoy and President Duterte, mining has been in the doldrums. But if we want revenues, and at the rate things are going, prices of commodities are going higher, it might be a good time to activate mining. But we just have to be cognizant about the impact on the environment, just have to make sure that proper measures are undertaken. But it can be a good revenue generator for both the economy and for the companies that are involved in it. I just wanted to add that, because I guess, quite frankly, that might be a dark horse that has to be mentioned. Thank you.
Thank you for that, Boss Rex. So last two questions. This one is for Sir Carlos, no? Or Boss Rex might want to add something to that as well. Is ATRAM planning to adjust the portfolio, specifically ATRAM Alpha?
Sorry, just to clarify, are you Alpha Opportunity?
Yes.
Okay. Right now, it is adjusted already. Remember that Alpha Opportunity is indexed against, its benchmark is small and medium cap stocks. So it has been adjusted already, especially since we are focused on the reopening of the economy. So it is already there's only minor adjustments that are needed for the fund, but generally it is already positioned for the economic reopening for 2022. A perfect example of that would be it is invested in GT Capital, very cheap right now, and it meets the market capitalization requirement of Alpha Opportunity Fund since it is less than 150 billion, and also Petron, again, a beneficiary of higher oil prices. So these are where the bulk of the portfolio is positioned. So I would say that there only will be minimal changes to the portfolio, but I think it is well adjusted already for our outlook for 2022.
Thank you for that, Sir Carlos. And I think to sum up all the questions that they have, we have here, kasi marami pong mga clients natin na they're asking if still 2022 is our recovery year. So are we still considering 2022 as a recovery year given with the opening of the economy that you were saying earlier?
Yes, definitely. I guess the perfect example of that is already the GDP growth. GDP growth came in at 8.3%. The estimate was only at 7.1% for the first quarter of 2022. It came in at 8.3%, and that is despite the fact that we had the Omicron surge in January. So yes, definitely. This is where we will see the reopening. The numbers are already pointing that out, and we are at level 1. Talks of downgrading to level 0 is already being talked about by the government. So we are already seeing the numbers. And definitely with less concern of a new variant coming about as the virus becomes less and less lethal, then the need for us to be put into a lockdown again is very unlikely already. So definitely the numbers are there. We're seeing it in the further loosening of restrictions. So the evidence is there that this is really the reopening story right now. It is just being hounded by the other macro concerns. But the reopening story, I think there's no stopping that.
On my end, Kim, I fully agree. We just have to call a spade, right? The COVID pandemic is a major black swan.
Yeah.
As you have heard Carlos and I talk about inflation, soaring commodity prices, and interest rates, we're talking about them in a sense where they are labeled headwinds. COVID-19 is not a headwind, it's a major debacle, right? And if we're going to be recovering from COVID, I guess that's going to be a larger, bigger, more potent factor than the others that were mentioned. So much like Carlos, I believe that if we get ourselves to normalize in the economy with a higher level of consumer confidence, I feel that 2022 will unfold to be the recovery year that we expected it to be. The only question probably is, how big a recovery will there be? Will it be tempered by all of these headwinds, or will the headwinds also simmer down by the second half of the year, so much so that the growth can be more robust as we expected it last year?
Thank you for that, Boss Rex. And for me, this is one of the most interesting Q&As we've ever had. So thank you again, Boss Rex and Sir Carlos. As much as we would still like to accommodate and answer all the other remaining questions, I'm afraid we might not have enough time for that anymore. So please just expect your business development officers to get in touch with you and help answer your inquiries. No? And so before we put our program to a close, may we please get some final words or any message from our two speakers? I think, Sir Carlos, you can go first.
Yeah, sure. I would just like everyone again for your time. Thanks for listening in. And my hope is just that I really hope that you learned a lot from this segment. And I hope that we will be able to monitor the new developments in the incoming administration. We are looking forward to it. And again, just practice emotional discipline, stay invested, and keep on investing, especially in these times of panic.
Boss Rex, you are on mute, boss. Yes.
Thank you. Thank you for that, Carlos. Again, I reiterate my thanks, our gratefulness for you and ATRAM support, and your presence in our webinars and in our events. For everyone, I may also thank you for being here with us, for being one in our webinar. There have been lots of registrations. We hit the limit in our numbers today, so I'm so sure that there were people who weren't able to watch the webinar as expected. So I guess, Kim, we will have to announce a repeat or a replay of this at an opportune time within this week. But let me thank everyone again. At the end of the day, I always say this, we do not control what happens. There are circumstances, there are events in our environment that we can never be able to control. But what we control would be our responses. And that's where our power lies. So I guess with that, I hope that we are all going to be very, very forward-looking and empowered investors. Maraming salamat po.
Thank you again to our dear speakers, Boss Rex and then Sir Carlos. And tama po kayo, no, as Boss Rex mentioned, we will be having a replay of this webinar para po sa mga hindi nakasama today. And before we announce our raffle winners for today, may we again invite everyone to please subscribe to our YouTube channel and follow us on TikTok, Rampver Financials, and experience how we help people fulfill financial dreams.